Joining me to dig into retail earnings is Christine Short, head of research at Wall Street Horizon, a TMX company. Christine, thanks so much for joining us.
Yeah, thank you for having me.
Christine, let's start with Target because news of this CEO shakeup seems to be really overshadowing the actual numbers. The stock is sharply lower right now. Why do you think investors are so disappointed with Brian Cornell stepping down and with the COO replacing him come February?
Yeah, you're right. It's a little surprising to see investors react this way because they did actually beat on the top and the bottom line. They're still, EPS is still down 20% year over year. That is the fourth consecutive decline. Revenues were down about 2%, the third consecutive decline. But overall, this story has not been getting much better. And, perhaps investors will change their mind about a new CEO. A lot of times they greet that with, positivity because it has not been going so well for Brian Cornell. Michael Fiddelke is an insider. He's the former COO. He won't take his new post until February 1st. So we'll see if sentiment changes over that time. But I think what you're seeing in the stock today is just an overall reaction to the difficult environment that Target has been dealing with. We did see a couple of segments pick up versus what they were in the first quarter, but really it's just food and beverage, which we know only makes up about 20% of their revenues, but that's the only segment that's consistently been doing well. We know beauty, which they've tried to uplift a little. It did perk up a bit this quarter. It just barely eked out a beat, but we know that partnership with Ulta to open mini beauty stations throughout the stores has fallen through. And then with tariffs, about 50% of their goods are produced in the U.S., but that's less than you see at a competitor like Walmart, which is about 2/3. So they do have more tariff exposure, and it's a bit of a double whammy with the tariffs. And then the consumer, who is really value driven right now. And Target, used to once be a beacon of sort of unique items. They've had an issue with product mix. They've had issue with customer service and just providing the same cachet that the store once had. So I think there's a lot going on here, and investors came into this report, hoping to see more, but not quite getting what they wanted.
It's been a very different story for Walmart this year than it has for Target, and we still like to compare the two, but what lessons could we learn from Target that could apply to Walmart, which reports tomorrow?
Yeah, you're right. They are peers, both as discounters, but they have a very different story. Like I just said, even when it comes to tariffs, they have less exposure. They have a larger grocery business, and we know consumers are really looking to purchase necessities right now. 60% of Walmart's revenues come from their grocery business. They're really seen as a one-stop shop. So you come in for groceries, but you actually might spend some of your discretionary income as well. They've been negotiating with their vendors. They've been negotiating with supply chain. And so as the world's biggest retailer, it's maybe a little bit easier for them than Target to get some of these deals done. And they are committed to keeping prices lower. I know Target's tried to do the same, but I think Walmart's been a little more successful, especially at a time, like I said, when the consumer really is bargain hunting.
Speaking of peers, Home Depot and Lowe's are both out as well. What's the takeaway when it comes to the home improvement space?
I mean, overall, both did, I think, better than expected. So Home Depot did not be on the top and bottom line. They missed expectations, but they did hold onto full year guidance. You saw investors react positively to that. The stock popped about 4% after that report. But they did say they're still seeing this deferral of large projects in the home. So large ticket items were up about 2.6% year over year. Those are purchases of items over $1,000. So that was a positive. But overall, like I said, those big home improvement projects, they're still seeing the deferral that they've really been seeing over the last couple of years. They are trying to get more into the home professional space, which I think Lowe's has been a little more successful with. When they reported this morning, they beat on the top and bottom line. They raised full year revenues. They kept comp store sales the same and lower range for their EPS for the full year. So it wasn't a slam dunk on the full year outlook, but pretty good to see that revenues were increased based on the recent acquisition of Artisan Design Group. That is a home professional group. They also announced an $8.8 billion acquisition of another home professional group. So they're really leaning into that area of the space because it's more lucrative. It's a little more steady. at a time when they're, just not seeing the same home improvement sales and activity because there's not as many new home buyers in the space. So you're seeing, because of higher mortgages, higher borrowing costs, there's not as many new home buyers. And so they're lacking a little there. But I think on the home professional space, they've been able to offset that a little bit.
And then there's TJX, which has already been a winner this year and is now an earnings winner as well, beat on both the top and bottom line, but also raised its outlook. What's the biggest takeaway there?
Yeah, the off-price retailers are really poised to do well in this environment. The analysts love them because, look, it's on the tariff front. They're not contending with tariffs as much as a traditional retailer or a department store because they're taking excess inventory from other brands. So things that have already paid tariffs. So they're not having to deal with that. And also, just as an off-price retailer, I mentioned a bargain hunting customer and consumer, and they're offering discounted prices. And so, like you said, TJX, the sort of first out of the gate here. We've got Burlington later. We've got Ross Stores as well. But they beat on the top and the bottom line. Earnings per share and revenues grew year over year. They raised their expectations for earnings per share for the full year to, I think, $4.54. It was almost a 20-cent increase. And they expect comp store sales to be at the higher end of their range at 3%. So a lot of good things working in TJ Maxx's favor, and we'd expect to see that trickle through to some of the other off-price retailers as well.
Christine, you've mentioned tariffs a few times. What is kind of the overall consensus about the impact the tariffs are having from retailers, and are they passing on higher prices onto the consumer yet?
Yeah, I think most of the retailers we've tracked have said they're really trying not to, but yes, some of those higher prices have trickled in. As we know, the tariff and trade policy picture has changed quite a few times this year. Just last week, there was another pause on Chinese tariffs, so a bit of a sigh of a relief there, but we're still seeing Chinese tariffs on imports from China 30%, whereas prior to this year that we didn't have tariffs of that size. So a lot of these retailers are still contending with those, but again, relieved that they haven't gone up to some of the percentages that we've heard thrown around, 125%, 145%. So we have a pause until November. We'll see what happens at that point. So it's still a bit of an uncertain picture for retailers because they're not sure what happens come November, but they're trying to prepare as best they can. Like I said, some of these are negotiating with suppliers. They're trying to move countries of production. They're trying to move away. Target, for example, just in 2017, 60% of their imports were from China, and they've gotten that down to 30%. And they said by the end of next year, expect that to be closer to 25%. So retailers are trying to, as quickly as they can, move supply chains. But as you know, it takes time. But many of them had said, yes, this will creep into pricing. And we've started to see that, and we're starting to see consumers a bit fatigued with the increase in prices as well.
How strong is the consumer based on what these retailers have been saying?
Like I said, it depends which retailer you look at. I think the consumer's been surprisingly resilient in the face of a lot of this. I think the one thing that concerns me the most is the labor market. We know that the consumer will roll with inflation and higher prices. We've seen it, really in the wake of COVID. We've been dealing with higher cost of items, right? But it's because, for the most part, folks have felt comfortable that they can keep their job. If they, needed to get a new job, they'd have the ability to find another job, and that their employment is safe over the next 12 months or so. Now that we're seeing the labor market, non-farm payrolls a couple weeks ago for July came out, and they were weaker than expected. We had revisions to the June and May numbers. Unemployment is still historically very low at 4.2%, but we're starting to see a few cracks in the jobs picture. And I think that's where you start to see consumers get a little nervous and hold back a little bit. We are in the back to school shopping season, so we've seen retailers talking about that. Consumers are still coming out for that, maybe not in the record droves that they did last year or even 2022. This is the second largest shopping season outside of the winter holiday season. So they're still here, but I think they are, again, looking for value and looking for a bargain.
Okay. Christine Short, Head of Research, Wall Street Horizon, a TMX company. Thank you so much for all of your retail insights.
Thank you so much for having me.